and you'll be able to get some extra credit points if you participate in it. Talk about it in a little bit. Here's vessel sampling. Tonight, I'm also going to send out the chapter 1 and 2 exam after class. And that will be due on, I think, the 23rd. Let me check. Nope. So by Friday of next week, you'd have to have it. So I should get that out tonight. It might be tomorrow, but more likely it'll be tonight. Okay. I'm gonna go ahead and save this. Sorry about taking the time here. I thought it was doing it quicker, and it usually brings up my. Okay. Okay, so let's pull up the chapter 1 and 2 handout. A little ways through it. And I think we stopped on letter K. Okay, Securities Exchange Commission. Securities and Exchange Commission are the biggest regulators of companies in the United States. And if you're talking to people in companies, you know, they don't worry too much about the IRS. They just don't. You know, the IRS, they may give you a fine or something, but it's not that big a deal. But the Securities and Exchange Commission is really serious, and a lot of times people can go to jail if they get on the wrong side. And you can do that for taxes too, but it usually doesn't happen in corporations. Okay. So the SEC. The only SEC only regulates publicly traded companies. The AICPA term for that is those are issuers. Oops, let's try that again. So publicly traded companies are regulated by the SEC. Non-issuers. The SEC has no authority Yes, he has no authority. I spelled correctly. Oops. Or privately held corporations. states do have some authority of privately held corporations. Not as much as the SEC has over publicly traded companies, but the states do have some control over it. But the SEC, the federal government has no authority over privately held corporations. So if you're IBM, you have to keep your books according to GAAP. Why? Because the Securities and Exchange Commission says you have to. If you're a privately held company, you're Joe's hot dog stand, you can keep your books however you want. They don't have to be GAAP. You keep your books based on cash or whatever method you choose to use. Now, when you file taxes, you have to file tax forms correctly, but as far as keeping track of your books, you can do it however you want if you're not publicly traded. There's no organization that says how you have to keep your books. Okay. Public Company Accounting Oversight Board, PCAOB. I wish they had a better name for it, but that's what it is. So PCAOB. This is a department in the Securities and Exchange Commission. It was created by Sarbanes-Oxley Act. So the Sarbanes-Oxley Act created this, the PCAOB. Now I'm going to change this. Better writing. PCAOB, I don't know about that, but PCAOB is a department, Securities and Exchange. It was created by the Securities and Exchange Act, and it regulates publicly traded companies and their auditors. One more thing up here. All auditors of publicly traded companies, also known as issuers, oops. It must be registered by the PCAOB. You cannot do an audit, even if you're a CPA, you can't do an audit of a publicly traded company unless you're registered with a PCAOB. So there's a little bit of a distinction there. The states give you licenses to audit companies. However, if it's a publicly traded company, there's another step involved. You have to get registered. Your firm has to get registered by the PCAOB. Usually these are very big CPA firms because obviously big companies take a lot of people to audit. Okay. A few questions, let's see here, and by the way, if you don't want to answer, you can put it in the chat if you want. Which of the following organizations can license certified public accountants?
Is it D?
Nope. PCAOB registers CPA firms.
A.
Nope. Excuse me. States.
The states? Oh, yeah.
Yeah, the same, just like your driver's license. So, think about license, think about driver's license. Driver's license by the state, says you can drive a car and whatever. Okay, which of the following organization can revoke it? Well, kind of the same vote, who can revoke your driver's license? The only people that can revoke it are,
The state.
state says you're too crazy, we can't let you drive, they're the only ones who can revoke it, same way with the CPA for CPA license, that you're too crazy. They can revoke your license.
So the states actually monitor your public, your CPA license?
Yep.
They do? Oh,
Yep, the states monitor it, you have to send in your continuing education stuff. They also monitor it for, things like if you committed felonies and all that kind of stuff. One of the things that is also true, I don't know if it says this or not, but if you fail to file your taxes, you can get your license revoked. So, there's all these, they make you follow a number of rules, and it comes under professional law, basically is what they call it. But for instance, doctors, lawyers, those are all professional laws.
would this be, so the public accounting overboard site, they would not be the ones to revoke your license? No.
They could revoke if you had if you were registered to audit publicly traded companies. They could revoke that, but the license itself.
Oh, got it. Okay, I see what you're saying.
So
Okay.
yeah, now they can revoke the registration, and if you're a large CPA firm and they revoke your registration, you're pretty much out of business. But they don't have any control over the licensing. So the state regulates your license, and they'll, you have to do certain things. For instance, we're held to a higher standard, basically. There's a number of people that are held to higher standards, and one of them is CPA firms. You have a general obligation to the public and some things like that. For instance, we have to report abuse. We're anyone who's a professional must report. So if you see anything abused, whether children or elderly or whatever, you are required to report it. That's one of the things. Doctors are under the same thing. You'll have all these other groups that are under the same thing. So anyway, you're held to a higher standard, and you can lose your license for a number of reasons. But for the most common ones are people commit crimes. That's how they lose their license, or they don't do the continuing education, that kind of thing. But yeah, the state definitely, though, they regulate it. It's every 3 years. It's only, I think, like $90. I mean, I could be wrong. Maybe it went up, but the last time I did it was $90 for 3 years, which is very reasonable. Okay. CPA firms. Local firms. We usually have between 1 and 10 partners. You can have once you get your CPA license, you can start your own firm. Now, there is a sort of limitation of how much business you can do just by yourself, because obviously if you're one partner, you can't start doing large company audits and things like that. Usually you have to have a pretty good group of people to do that. But there are CPA firms that are just one person, and maybe they have a couple people working with them, but it's not uncommon. And sometimes they have more people come in. It's not uncommon to have someone who's an expert in taxes, someone who does auditing and write up, financial statements and all that kind of stuff. But smaller firms, and generally the size of the firm kind of goes along with the client. Usually smaller firms have smaller clients. Smaller firms may have individuals that might do taxes for individuals. And they might have like some of the smaller businesses, maybe up to a medium-sized business, but usually not much bigger than that. Regional firms. These have 10 plus partners, and so they usually have like 10 plus clients, and they have a larger region usually. They might be in a few states even, So for instance, you may have a firm that works in Illinois. Say Wisconsin, Illinois, and Indiana. They might work in more than just a local, that they actually have sort of a region that they'll go around. And again, some of the larger the larger businesses, the larger medium-sized businesses, something like that, a lot of times they'll have regional firms. If they don't have a really wide network across the United States, maybe they're based out of this area, then a lot of times that they will go with the regional firms. National firms, as you probably for your 50 plus partners. And they might work in most, if not all, the states. And what tends to happen is, if you have if there's a business audit that has offices in many states, let's say that they're a business. Well, actually did some work just recently with a testing site. They do like testing for people to take medical licensing for licensing states. Anyway, I think they're in 26 states. So to do an audit of that, you would probably go with a national firm, because they're in 26 states. A regional firm is not going to be able to do that most likely. But a national firm could, that they could go, into the states that they have. And the international firm, the big four, and they have hundreds of partners all over the world. And they usually have clients that are all over the world. Not necessarily, but a lot of times you'll have them, their clients will be if you have, for instance, it's Ford, I think they manufacture in something like 20 countries. Well, you need to have a really big network so that you can have people audit those countries. And not just because, and you say, well, why don't we just send, if we're working, I say, why don't we just send the US auditors over? Well, they may speak Portuguese somewhere, or if you don't have auditors who speak Portuguese, you're not gonna do very well. So you have an audit firm there that either is with you or, an alliance with them, that they will do part of the audit. They speak the language, they know, it's gonna be a whole lot easier. So you have all these countries all over the world, they'll have built all over the world, and you'll have local people who speak the language and all that kind of stuff to facilitate those things. So they'll either, they'll be directly partners in the firms, or they will also be, or they may be affiliated, okay, we use this firm when we're in wherever. Okay. Question number 7. Which of the following types of Cpa firms would be appropriate to form an audit of a bakery that has operations in Illinois and Indiana?
Local?
Yeah, probably either local or regional.
Okay.
Yeah, either one. It could be local. By the way, one more thing I should tell you is that you can generally audit in a different state, but you have to apply for that to do it. So, and there's a time limit. So they say, okay, I got a client that has this place in Indiana. I need to do the audit there. I'm not licensed in Indiana. You can, if you're licensed in Illinois, you can apply for it and get a, it's usually restricted by time. You could have 2 CPA, you could become a CPA in Indiana and Illinois and pay the fees for both of them. And if you do a lot back and forth, you might do that. But anyway, you can apply for it. So it isn't that you cannot do it if it's in, say, Indiana and you're licensed in Illinois. You have to apply for I forget what they call it, a variance or something like that.
So I do have a question about that question. So if you are, I was just thinking in terms of a bakery, like a smaller business, but if you are, does it matter like the size of your business, which audit firm that would probably be appropriate to perform the audit on your company?
Yeah.
Oh, it does. Okay.
Yeah, and usually, locals are usually smaller, or even individuals. National regionals are usually in a certain region that does business. Like, Illinois, Wisconsin, and Indiana is a common. They have a lot of common stuff, and then the national firms and international firms. And 2, as you go up, the audit fees usually go up. So you might do a local firm if they could do it, if they had enough people to do it, and there are some that will. They would probably be cheaper than the regional firm, and the regional firm will be cheaper than the national firm, and those will definitely be cheaper than the Big 4. The Big 4, they're the most expensive. So, a lot of times the fees, if you can get it done by a national firm, let's say you need to have an audit, you're publicly traded, or even if you just need an audit for your banking or whatever, just get a regional firm to do it. They'll probably be cheaper than, say, a Big 4 firm. Okay, positions in the CPA. Now, you might think, okay, this is our corporate structure. Who cares what the different positions are? These positions are in CPA firms. And I'll tell you what I mean by that. The rules made by the ACCT are directed at these levels. And so here's what this means. So there's 4 levels they recognize: staff assistants or assistants or associates, seniors, managers, and partners. These are the 4 levels. And they will tell you to, so let's say that you have a CPA and we go, well, we don't have those. No, we don't have seniors or whatever. The ICPA says, okay, well, take all your people and put them into one of those 4 categories, because that's, our rules are directed at, if you're an assistant, if you're a senior, if you're a manager. So even if your firm is not set up in that format, when it comes to the rules for the AICPA, they say, okay, all your staff, your professionals and all that, fit them in somewhere. They have to go into one of those 4 categories. So even if your CPA firm is not in this, formatted or structure, I should say, maybe it's the ACCPA says that you have to put them into it for the rulemaking stuff. Okay, staff assistants. These are new hires usually. Do not need to be a CPA. Okay, new hires. They usually have to be eligible to take the CPA exam. So you do not have to have a CPA when you start, and most people don't. Usually firms will give you access to a CPA review. Okay. So usually firms will give new hires access to the CPA review and reimbursement for the cost of taking the exam. So you don't have to be one, but they would strongly encourage you to get a CPA. Okay, senior auditors. When we're audits, must be CPAs. And another thing is that the CPA exam is usually focused on them. Okay, so here's kind of the relationship. When you're a staff assistant, they will usually try to rotate you around and get you to audit cash and receivables and inventory and all this stuff you need to know how to audit for bringing audit on your own. And then if you do okay with that, they'll bump you up to senior auditor where you actually run one of the audits. And they do it fairly quickly, 2 years. It's fairly quickly. They must be a CPA. If you're not a CPA, you cannot be a senior. And the CPA exam is usually focused on the senior auditors. It's from their point of view. You know, staff assistants, you know, every question, the answer would be, you know, what do you do in this case? Hey, you know, ask the senior. Whereas the senior, they're the ones getting asked. So this is one of the, these are usually the people that are on site for the audits. So staff assistants, 0 to 2 years, senior auditors, 2 to 3 years. Senior auditors is probably the, you know, that's usually the focus of the CPA exam and pretty much everything we do. Managers. Managers will usually oversee 10+ audits. And several senior auditors. They usually are not on site. They can be, I mean, they sometimes will show up, but usually they're not. And if there's trouble with an audit, you know, this audit or that audit or whatever, they're there to fix kind of the audit stuff. So the managers are actually the ones that are oversee the seniors, make sure that all the audits come in on time and what they're, you know, under budget or on budget and all that kind of stuff. Partners are kind of the ultimate. And partners are required to bring in clients. They generally don't do much more than that. They're there to bring in clients. They'll oversee a little bit. They may oversee some of the auditing stuff. But they really are not, they usually the hands-on type of people. They're there to bring in clients. And by the way, this is for every partnership. You can be a terrible auditor and be a great partner. Partners are required to bring in clients, and that's, you know, whether you're if you're in a law office, a law partnership, it's the same thing. You know, how do you become a partner? Bring in clients. That's really the only thing that they're there for. And that brings up a kind of an ugly part of the, I shouldn't say it's ugly, it's really not, but in a CPA firm, the employment is either up or out. You know what I mean by that is, you'll notice that staff assistants, it isn't 0 to 20 years, it's 0 to 2 years. Senior auditors, it's not, you know, 2 to 25 years, it's 2 to 5 years. And there's a good reason for that. And by the way, that is one thing that you find in all partnerships. Let me kind of show you why it's like that. So focused on. Okay, so in a CPA firm. Okay, so here's the partner. And so here's a partner. And maybe a couple of managers. A couple of seniors. Move this up a little bit. Hey. And so underneath here, we have a bunch of associates. Associates or assistants or whatever they're termed. Okay, you have to have partners to survive. Now, let's say that you have some associates that are really good, they do a good job, but you can't really make them into seniors, or maybe there's no spot for them as seniors. You can't move them up. Maybe they don't pass the CPA exam or whatever. Notice what's going to happen if you leave these down here. At some point, all of these ways to get to partners are going to be blocked by people that can't be promoted. You won't have any seniors, you won't have any managers, you won't have any partners, the place will go out of business. So in all partnerships, in most of them, I should say anyways, it's generally up or out that, they need to have these open up, because something like 1 in 100 of people that come into a CPA firm become partners. So you cannot have these blocked up with people that can't go up, because like I say, only 1 in 100. Now, say, well, that sounds kind of cruel. Well, usually they try to get you a good job with one of their clients. So usually, the CPA firms will try to get it in with their clients. So let's say we're auditing IBM. They'll try to get you a job with IBM. They generally they don't just generally just hey, that's not me. They generally just don't let you go. They don't say, hey, clean out your desk and get out of here. What they generally do is they try to get you a job with other clients. So they'll say they're auditing IBM, and they'll say, IBM, hey, we got this really sharp assistant, but we just don't have a place for him or her going up. Do you guys have anything? And a lot of times companies will want to take it. CPA firms are generally considered the cream of the crop when it comes to accounting. For whatever reason, that's what they are. So a lot of times you'll get placed with one of the clients, and they do that as kind of having one of their people on the inside, shall we say. They do it to keep the business, basically. But they also, they wanted to have good relations and all that kind of stuff with. But you'll notice something too, though, about that. So up or out. So a lot of times it'll go into the client. Notice, and this is can be one of the kind of tricky things, is that a lot of times people in the accounting department come out of the CPA firm. Now, those people, they know exactly what CPAs do. They know what you're gonna test, how you're gonna test it, and that sort of thing. So, well, in the one place, on one hand, it's good, they have people who have knowledge about auditing. On the other hand, it can be a little bit dangerous because they know exactly how you're gonna do it. If they are set to do something bad, they would have a better chance of hiding it from you. Okay. That's what I have here. And we'll push through. Okay, let's go on to chapter 2. I think we talked about this last time. The AICPA. Do they make rules for non-issuers or issuers? Did we talk about this? I can't remember. Let me look up here. Oh, here. AICPA, it's only a club. Now, they actually do make rules, but they have no way of enforcing them other than relying on government agencies. So, is it a government agency?
No,
Nope. Do they issue or revoke CPA licenses?
no,
Nope. Do they register CPA firms?
yes.
Actually, no, that's the
Oh, no,
PCAOB. They creates the CPA exam.
yes,
And again, they do issue rules for these. They actually don't enforce them. They're not a government agency. Okay, state laws. They make laws for both. They make it for laws for non-issuers. They are the ones that grant corporations. So they have control over non-issuers. They also have control over issuers. Just because that they are, just because they're under the PCAOB doesn't mean they don't have to follow state laws. If there's a conflict, then yeah, but it hardly ever happens. So they have to follow state laws as well as the federal laws. Our state's government agencies. Oh, you guys know this.
yes,
Yes. They issue revoke CPA licenses.
yes,
Yep. Register CPA firms.
no,
It's CPA exam.
no,
They could, they just don't. Public Company Accounting Oversight Board, they are only for issuers. They cannot do anything to non-issuers. They have no power. In some ways, it's a little bit funny, IBM was afraid of them, but Joe's hot dog stand isn't. Is it a government agency? Yes. Broker issue state licenses? No. Register CPA firms. Yes. If you want to audit publicly traded companies, the PCAOB, which I wish it had a better name, but they're the ones that register you. And they create the CPA exam, no. Okay. Misstatements. What type of misstatements do auditors look for? I think we talked about this, but remember, only material misstatements. This next part is important. The characteristics of an error versus the characteristics of a fraud. What separates those two?
Integrity, for one.
Yeah, and the legal term will tell you that it is intent. And one of the hardest things about fraud is proving the intent. But exactly the integrity of it though. This one is an honest error, right? This is a dishonest act. So intent is really what separates those two. And an error, you don't go to jail for an error unless it's something really crazy, but generally for an error, you don't go to jail. There's no intent. Whereas fraud, intent. And one of the things that Yep, weird. Yeah, exactly. One's intentional. Yeah, intent or intentional. It's an intentional act. And you have to prove that in court, to get it actually is fairly hard to get a conviction on fraud. Because you have to prove that it's intent. It can't just be an error. Oh, I didn't know I sent that check out. I didn't know that I wasn't supposed to, or whatever it is. So in a court, you have to prove intent. Okay, types of frauds. Type 1 fraud is financial statement fraud. So type 1 fraud is financial statement fraud. It is misstating the financial statements. So, cooking the books. This is the financial statements are fraudulent. It could be that they're fraudulent to get a loan. It could be they're fraudulent to make the stock price go up or whatever it is. But they're misstating. Type 2 fraud is misappropriation of assets, which the term I just think is hilarious. This is employee theft. So misappropriation of assets is usually the employees taking the assets. So this is type 1. Type 2. And this by the AICPA's term for type 1 and type 2 fraud. As an auditor, which one, an external auditor, I should say, which one are we more interested in? Type 1 or type 2?
One.
Yep. Yeah, you're more, we sign off on the financial statements. And so we're looking to see if the financial statements are the same. Not that we don't look for fraud, we do. You must look for fraud, it's required. But generally speaking, if the financial statements are presented fairly or not materially misstated, that's usually what all we're doing. And as you get into larger companies, it would take an awful lot of type 2 fraud, an awful lot of employee theft before it becomes material. We're talking tens of millions of dollars. So it usually isn't very common to have, especially larger companies, the type 2 actually become material. Smaller companies, you can't. You can have somebody that steals half the company. Larger companies, it's very difficult to have that actually ever, become material. Okay, compliance with laws, illegal acts. Laws with direct effect. Are more of a direct effect are more of a concern than indirect acts. Let me give you an example. So income tax fraud. Will have a direct impact on the financial statement. So their tax expense will be understated. So illegal acts are direct illegal acts are more of a concern. They're those things that will directly impact the financial statements. So if they are cheating on their taxes, well, then their tax expense is probably too small. If they're cheating on, say, import tariffs, well, then their costs are too low. They'll have a direct impact on the financial statements. Other laws are less of a concern. Okay. Other laws that are not direct will have less of an effect on the financial statements. Okay, so an example of that would be violations of the EPA requirements. Now, it's not good to have violations of EPA requirements, obviously. But at the same time, violations of EPA requirements, if there may be a fine involved, there may be nothing. As long as the EPA just tells them to knock it off. So, there is less of a direct impact, whereas cheating on your taxes has a direct impact on your income tax expense. Violations of EPA laws as auditors, when we're looking at the financial statements, we don't give as much credence to those because they may not have the dollar impact that would be material for the financial statements. Not that it's wrong to violate EPA, rules, but when it comes to financial statements, it's much more vague as far as if there is a liability or, like you say, a lot of times the EPA just tells them to knock it off. So those are less of importance to us as auditors. Responsibility for detecting illegal acts is the same as anything else. I've got some letters here. You're only responsible to look for illegal acts that are material. Responsibility for reporting illegal acts. Generally, illegal acts are reported to upper management. It depends on who's doing it, obviously. The board of directors and the audit committee, if they have an audit committee. So generally, you report to upper management, board of directors, and this is especially true if management's involved. Or if they have an audit committee, you report it to them. Now, it is a tricky situation. People say, well, don't you go to the police? No, you actually have a fiduciary duty to your client. It's not the same as for a lawyer, but it's pretty close in that you have fiduciary duty. Now, are there times that you would go to the police? Yeah, there are. Usually you have to get a lawyer to determine when you can do that. But if it's an illegal act, if upper management especially isn't involved, you contact upper management, board of directors, audit committee, and they should take appropriate actions. If they don't take appropriate actions, and then we'll actually talk about that later, what happens, but yeah, so generally you report it to upper management. Okay, I'm gonna stop here. It's taking longer than I thought. We'll go through these. Let's stop here. And when we come back, oops, that's not supposed to stop. It's still not how you're supposed to stop it. We will finish this up and do the multiple choice code. So let's say be back at 7:10. Okay. Oops.
Hey, Professor, can you scroll up to K and L so I can take a picture real quick?
Absolutely. I gotta do K first.
All right, I got it. All right, thank you.
And you want to get number 6?
Yeah, I got 6.
Okay, great.
Oh, Professor, we can't hear you.
Now, is that a good thing or a bad thing? Wow. Sorry about that.
I'll just,
Oh, that's so nice. All right, no, but so types of reports. What we're really talking about here, thank you for telling me. Are the type of reports are based on the opinions of the report. And remember, we don't do the financial statements that you know, the company does the financial statements, we just give the report along with it. But you know, so we don't actually do it. So the reports, the different opinions, so the opinions are gonna be good or bad, that kind of thing. So those are the type of opinions we're talking about is when we look at the financial statements, we have to give an opinion on it. And that's what these are. It's come in the form of a report. But an unmodified or unqualified report, this is a standard report, sometimes called a clean opinion. And this is what most companies want and what most companies get. And I'll talk about it in a second here. Okay. The next report is a qualified report. Or a modified report. Actually, all of these down below here are going to be modified reports. AICPA wording. A qualified report. When do they get it? They get it when there is a okay, qualified report. Qualified report is when there's a material misstatement that only impacts one or two accounts. Overall, the financial statements are fairly presented. So they'll say, okay, there are these two accounts that we can't verify the inventory for whatever reason, maybe. But overall, the financial statements are okay. So a material misstatement impacts only one or two accounts. Financial statements are fairly presented. The statement is not pervasive. It's not in, throughout the financial statements. These are often called except for opinions. Or except for reports. And that's from the wording in the report itself. Because the wording in the report itself will say, everything is great except for, and then goes into the bad stuff. So a qualified report, so, and all the rest of these are modified. So again, it's, the except for opinion, that's usually you hear these called. Except for, because they'll say everything's great except for, and then it says the bad stuff. Yeah, so if you're except for opinion, that's what it is. Okay. I'll put something else in here. But the misstatement is generally known. In other words, we know the dollar amounts. And we put the dollar amounts right in the report itself. Okay, worst type of opinion you can get is an adverse opinion. Where does it report? And the misstatement is known. Not generally known, it is known. And dollar amounts reported. And this is in the financial statements. Financial statements are not fairly presented. This is the worst report you can get. The misstatement is pervasive. Goes throughout the document, throughout the financial statement. Could be more than one. These are not GAAP. Furthermore, they cannot be relied upon. So adverse, why did the space? Okay. So for these two, the dollar amounts are going to be reported. So let's think about this for a second. Suppose that we tell the client, look, your revenues are overstated by $20 million. We want you to fix it. Now, if they don't fix it, they're going to get, let's say they get an adverse opinion. Does that mean nobody's going to know about the $20 million overstatement? No, they are. It's going to be right in the report. So it isn't like they're going to be able to hide this from anybody. It's going to be in the report. So one of the reasons why qualified opinions and adverse opinions are pretty rare is that there's no benefit to it. Not only is you can have this report that goes along with it that says, don't trust these. It also shows that reflects on the management that they are, trying to create a fraud. So there really isn't too much reason for management to want to have, an adverse opinion or a qualified opinion. It's usually in their best interest to go ahead and make the changes, even if they don't agree with it. I don't agree with it, but okay, we'll make the change just because I don't want to get this bad report. Okay, the last one is a disclaimer of an opinion. It actually is not an opinion. It's a type of opinion, but it's not there is no opinion given. And this is when Not enough evidence can be collected to form an opinion. So this is when the auditors, they want it, and usually the client too, well, it can be, it can work out a couple different ways. But there's not enough evidence can be collected to form an opinion. And it can kind of come in two different scenarios. Suppose you're auditing a place and you walk in there and the place has been robbed, they don't have any computers. Someone came in and stole all the computers that had all the the accounting software and all that. Okay, well, how about the backups? Well, they were in the safe. Where's the safe? Oh, they took the safe too. There's just not enough information to actually form an opinion. So when that occurs, you give what they call a disclaimer. And the disclaimer is, look, we don't know. We're not saying the books are misstated. We don't know if they're misstated or not. We don't have an opinion. We cannot get enough information to form an opinion on it. So a disclaimer is sort of like nothing. It's kind of a weird thing. You go through the audit, and at some point during it, you probably end up stopping and saying, look, we can't get the information we need. But a disclaimer is just that. It says there is no opinion. We don't offer any opinion on it. Oops. Here. Okay, so disclaimer is not enough. Okay, a couple things here. Now, one thing is, we say, okay, well, suppose you can give someone an adverse opinion. They go, look, don't give us an adverse opinion, give us a disclaimer. Your revenues are misstated by 20 million. You're getting an adverse opinion. No, just give us a disclaimer. Right, just say you don't know. Can you do that? Can you bargain away, say, a qualified opinion or an adverse opinion and give a disclaimer instead?
No.
No, quite honestly, you'd be part of the fraud at that point. You're saying you don't know when you do. So you cannot bargain away a qualified or adverse opinion with a disclaimer. A disclaimer is usually come about when there's not enough information. Sometimes the client won't cooperate. Sometimes they don't realize what an audit is. I had a friend who did an audit, and the guy, he didn't want them looking at his inventory. Well, it's part of an audit. The inventory is an asset, determine your income and all that kind of stuff. And he just refused. No, you're not going to look at it. Just look at the financial statements. That's part of the financial statements. And so, he refused. They gave him a disclaimer. Here's our bill, and here's nothing. Okay. And these are judgment accounts here, judgment of what kind of opinions are available. And, so quite honestly, somebody could go one or two ways, but just in general, going through these, seeing what do you think would probably be the right one to do? Okay, the auditors were looking at significant investments by their client, and they couldn't verify them. Whatever.
That'd be the adverse.
It could be adverse, probably, or qualified. It depends if it was just that account, it could be qualified. If it was significant, well, no, if it was significant enough, this term significant, if it's significant enough, it could be adverse. So it could be either one of those two. Okay, the auditors determined that cash, inventory, and revenues were all materially misstated. Which report would probably be appropriate with this scenario?
Probably definitely adverse.
Yeah, this is going to be your income statement. The revenues will be in your income statement, the cash, and cash is huge, and inventory is huge. So yeah, those would all be, means that you can't rely on the balance sheet or the income statement. Okay, the auditors determined that cash, inventory, and revenues were immaterially misstated. I gotta do something here. I gotta send out. Shoot, did I send it out already? I can't remember. All right, oh, the auditors determined that cash, inventory, and revenues were all immaterially misstated. Which audit report would be appropriate for this scenario? So they're misstated, they're not materially misstated, they're just misstated.
The, uh,
If it's not materially misstated, what report do they get?
the qualified report or the disclaimer,
No, no,
the qualified? Wait,
actually, that's a clean opinion.
oh, is it?
Yeah, if it's immaterial, so if,
Oh, immaterial, got it.
yeah. Yeah,
I
so
still
no,
think it's more material, okay, okay.
well, no, but here's the thing too, though, when you're reading CPA questions, that sometimes they'll say whether it's misstated, if they don't say it's materially misstated. Almost all accounts are misstated, especially in larger companies, they just are. It's impossible to be 100% correct when you have millions, if not billions of transactions. So, but the question is whether they're material or not. So if they're misstated, but it's immaterial, it's a clean report. So this is a clean opinion. Okay, the auditors were unable to verify material amount of offsite inventory on a client's books. None of the other accounts were misstated. Which audit report would be appropriate in this scenario? This could actually be one of two.
Modified,
Could be modified. Now, notice that they really don't know whether these are misstated or not. So it could be modified in for qualified, and if it and you just simply say that this dollar amount we can't verify. You also might give them a disclaimer. The inventory affects the sales and costs and all that. You might say, okay, we really don't know enough to so it could be either one of those two. Oh, why are qualified and adverse opinions rare? Actually, B. Whoever reads the report's going to know what the misstatements are. So qualified report, it means that you know the misstatement, or that there's a certain amount of it that you don't know, but they're going to have dollar amounts involved. So qualified adverse opinions are very rare. They don't do the client any good. Okay, I sent out I think. Give me a second here, let me make sure I get out. Yeah, you should get the have the multiple choice questions. They should have came through your email. They're also in Blackboard. And so here's what I'm going to do. So, first of all, let me stop. Is there one that did not get this yet?
was that for, let's see here.
I sent it out.
This is new?
Yeah, I sent it out at like 7:11 or something. So it also should be in Blackboard. It's in Blackboard. If you go to assignments and exams, they're also in there.
Oh, I got it. Okay.
So there's 10 of them. And so what I'm going to do is put a poll up. And anyone that answers the poll, let's see. Okay, so you're just gonna go through and either A, B, C, or D. There is no E, so don't pick that one. But go through each of these and see what you can, and basically you get extra credit points, and the extra credit points like this. If you get at least 5 correct, everyone gets plus 2 points extra credit. Add to your test. You get 7 plus 3. And if you get 9 out of the 10, you get plus 4. So whoever, who's ever included in the poll, get those. So you're gonna answer, so each of these questions you go through and some are really easy, some are really hard. This is what CPA questions are like. And go through and see if you can, and answer the poll when you A, B, C, or D. And when we get everybody answered, then we'll put them out there for everyone, and I'll tell you which ones are correct and which ones aren't. And some of these same questions will end up on the exam for chapter 1 and 2.
Professor, I have a question.
Yeah, but,
On the on the poll,
yeah,
does it matter that it gives us other options that's not available?
no,
Oh, okay.
I'll tell you why that's there,
Oh, no
because,
worry.
no, it's there because Zoom polls only allow up to 10 questions. So like, let's say that we have one that had 14 questions. I would send out 2 polls. I'd have the first poll 1 through 10, and the second poll, 11, 12, 13, 14. And then, for questions 15 through 20, it'd be, no question available, or whatever. What they termed it. There is no question. So that's why it's like that. It's just a quirk of, it's a quirk of Zoom. Is anyone still working on it? Multiple choice questions?
Yeah, I got a few left.
Okay. No problem. Okay, take a look here. Number one, the most popular answer was D, which is correct. Oops. Number two. Okay, now if you're wondering, like on some of these, you go, okay, well, why isn't it A? There actually are some, and this is a quirk of the CPA exam. We never say the financial statements are accurate. Okay, and it's one of those weird things that that's not me. That's not me either. One of the weird things about the CPA exam, though, whenever you see CPA questions that say, no, that we caught all errors, or that they're correct, or that they are accurate, generally those are not the correct answers, because we never tell somebody that the financial statements are accurate or correct or anything like that. We just say that they're materially misstated or fairly presented. We would, you know, admittedly there are vague terms, but that's what kind of what we tell. Okay. Okay, good. So if an illegal act is discovered, excuse me, you report it to the highest people in place, including the audit committee. you generally don't notify regulatory authorities. There are certain circumstances where you might. But, and you also don't do things like, search for all of the fraud in the place. If the company wants to do that, they can, but remember, our job is just to look at the financial statements. Okay, so 4, management, yep. Financial audits, very good. 100% so far. Right to practice as a CPA is granted by. Good, B. State Board of Accountancy. And remember, the AICPA, this is just a club, so they can't do anything. They don't have any governmental authority, I should say that. They're just a club, kind of like the Boy Scouts or Girl Scouts or something like that. The worst thing they can do is kick you out of their club. Okay, 7, which of the following just describes the reason why you have an audit report? Oh. It's actually D. Yeah, it's because a different interest may exist. C is true that a management fraud may exist and more likely be detected by the external auditors. Well, it is true to some extent. It could also be, just errors and everything else. It doesn't have to be management fraud. And that you do have different interests that are looking at the financial statement. People look at them for as an investment, look at whether to give loans or not. All those sorts of things will be in there. It could also be for management, like for instance, bonuses and things like that. Another thing I got to tell you about the CPA exam questions. The real rules for it are which are the best answer, not which is the only answer. So that's another quirky thing about the exam questions. And the actual rules are which is the best answer. There may be 2 answers that are right. And so it isn't necessarily that you chose an answer that's wrong, even. It's just that they would, in their term, the best answer is a different one. Typical C, yep. Make improvements. D, get that one. It all comes down to the last question. You guys got it. And by the way, this is another one of those ones that, until you've taken this today, you didn't know this, but when you see things like all illegal acts, we don't look for all illegal acts. We don't give absolute assurance for anything. Something completely different. All right. Hey, you got 9 out of 10. You guys all get +4. So let me see here. So download the results. So all of you will get +4. Pretty good. You guys got all of them. And that, but that, hopefully that'll give you a little bit more of an insight into the CPA exam. You know what, it is hard. It's hard to get 75%. You guys got 90. Great. But it's hard to get 75% on. Okay, so here's what I'm gonna do. I'm gonna send out the exam. Similar to the kind of stuff that's in the handouts and the kind of stuff that we in the multiple choice questions. And I should get that out by hopefully by tonight. Either certainly by tomorrow I'll have it out, but I'll try to get them out by tonight. And the only thing I'll say is make sure you submit the one that I sent you, because I'm gonna submit different ones to different people. So make sure you just that you submit the answers to the one you have. And I take the submissions any way you do them. If you want to do them on notebook paper, that's fine. If you want to print them and take pictures of them or scan them or whatever you want to do, yeah, feel free to do it. And now you can't retake exams. Everything else you can turn in. For instance, the chapter 1 handout, which actually we just finished up, so you guys can turn that in today. Yeah, so you can actually. Yeah, you can actually submit that one today. The chapter 1 and 2 handout. We didn't get the classical sampling. We'll finish that next week. But anyway, you can't retake tests. However, if you want to change an answer, and if I haven't graded it yet, then you can resubmit. You can submit it. Once I've graded it, you can't resubmit. But if you want to, so if you think about it, oh, number 3 should have been whatever. You can simply resubmit it, and if I haven't graded it yet, you can resubmit anything. But yeah, you can't retake tests, but you can resubmit as long as I haven't graded it yet. Any questions?
Yes, I have a question, Professor. So for the classical sampling Word document, for homework on question 5, are we submitting that right on this document or a separate sheet?
Well, you'll turn the whole thing in, all of the.
Oh, okay.
Yeah, and you, however you turn it in, it's fine with me.
Okay.
Yeah. But wait, to answer your question, no, they'll be included with the handout.
Okay. Okay. Yeah.
I get what you're asking. Yeah, just included with the handout.
Thank you.
You're welcome. Any other questions? And by the way, I backed up the, I did want to talk about it a little bit, but I backed it up till next week. So anyways, just in case people have questions on it. We didn't have time today, so. Okay, well, have a good, I'll see you guys in a week, and I should have the exams out shortly, and we'll be on our way.
All right. Thank you. Have a
you.
nice one. Be safe, everyone.
Thank you.
You guys.